Okay, so this is going to be our first class on the taxation of securities. Now, what's interesting in this class is that unlike other tax courses that you've taken or going to be taking this semester, like the taxation of partnerships or the taxation of corporations, you don't have to understand the business of the corporation. You don't have to understand the business of the partnership in order to understand how to apply the tax rules. The tax rules just apply to corporations, to partnerships, regardless of the type of business that they're in. When it comes to securities, in order to really understand the tax rules, you have to understand the economics of the securities. So in today's class, I'm not going to talk about taxation at all. All I'm going to talk about are the economics of the securities that we're going to cover during this semester. The two securities that I'm really going to focus on are options and notional principal contracts, or swaps, as they're commonly referred to. The tax rules with respect to options and the tax rules with respect to the notional principal contracts themselves are not complex. However, there are many anti-abuse sections that have been enacted that deal with options and swaps. And it's because of their use as economic tools that have allowed taxpayers or investors to get very favorable tax results that Congress doesn't think are fair. And so they've had to draft a lot of anti-abuse sections covering these instruments to stop taxpayers from taking unfair tax advantage. And a lot of this course is going to be dealing with anti-abuse sections. In the first half of the course, or even quicker than that, we'll go over the general rules that apply to the taxation of most securities. The problem is, by their very nature, it's hard to come up with a general set of rules that apply fairly to all securities. As a matter of fact, when I first started, I went to a presentation, and the presentation was given by a tax partner at Sullivan and Cromwell. And he described 14 different ways that you could buy a US Treasury bond and end up with 14 different tax results. And while we won't be going over this in our class, I do a presentation in which I talk about 8 different ways that you can purchase a stock and end up with 8 different tax results. And any time that you can have the same economic results and end up with different tax results, there has to be room for tax planning. Now, in the 8 different ways that you can purchase stocks and end up with 8 different tax results, there isn't one result that's always the best or one result that's always the worst. It depends on your particular facts and circumstances, and then you could pick which of the 8 ways that you want to own the stock would be best for you. So those are the types of things that we're going to go over during the course of this semester. Again, talking about the different instruments, talking about the different tax rules, and why one taxpayer might want to structure a transaction one way and another taxpayer might want to structure a transaction another way. So having said that, let's start with the course, and I will pull up the PowerPoint. And so we'll go through the PowerPoint. And then during my lecture, I'll go from the PowerPoint to the whiteboard and go through examples. Because again, I think the best way, and really the only way to learn and apply the rules with the taxation of securities and maybe the taxation of anything, is to go through actual examples. That it's very easy for me to give you a rule, but it may not always be that easy to apply the rule. And when you see the rule applied with an example, is the way that you really understand the rule. So the examples aren't in the PowerPoint. So as you're watching this, I would recommend that you write down the examples, and then you could replay the tape if you have to go over the example again, and make sure that you understand the examples. So having said that, let me now pull up PowerPoint. Right? And this is the PowerPoint. And you've already seen this in your material, because I've broken out each section of the PowerPoint that goes with each class. So what are we going to be talking about? Securities, the taxation of securities. And what security I think that we're most familiar with are stocks. And what are stocks? Stocks represent ownership in a corporation, the equity of the corporation. Everyone who owns part of the business is what's represented by a share of stock. You get the upside of the business, you take the downside of the business, and you hope to make money because your business is going to do well. When you buy a stock, you can buy a stock on an individual company. So if I want to buy shares of Apple, I can go into the marketplace, buy shares of Apple, and I become an owner of Apple stock. If Apple pays a dividend, I'll receive a dividend. If Apple is successful and makes a lot of money, hopefully the value of the stock will go up and I'll be successful and I'll make money. If Apple doesn't do well, the value of the stock will could depreciate, and I'll actually lose money. But that's the investment I think that most people are familiar with. And that would be purchasing an individual stock. Now, what if I want to buy a share of Amazon? And Amazon is trading at about $3,000 a share. And I don't have $3,000. All I have is $1,000. And not only do I want to own Amazon, but I'd really like to own a share of every stock in the S&P 500. And I certainly don't have enough money to buy shares in all 500 companies in the Standard & Poor's Index. So what's been set up are mutual funds. And a mutual fund is an entity where I would buy one share of stock of a mutual fund. And a lot of investors will do that. And we'll all put in a lot of money into this mutual fund. And the mutual fund will buy shares of the S&P 500, or they'll buy a portfolio of stocks. And while I, as an individual, couldn't afford to buy that portfolio of stocks, or the one share of each company in the S&P 500, by buying a share in that mutual fund, now I own a piece of all the underlying equities that the mutual fund owns. And so by pooling investors together, we're able to buy shares of these entities, and we now have exposure to many more stocks than we could have ever purchased on our own. And mutual funds will have their own set of tax rules that we will talk about. There are also funds called exchange-traded funds. They're mutual funds with a twist. So with a mutual fund, you buy the shares on a daily basis. You can buy them at the end of the day. And when you buy the shares of a mutual fund, you're actually buying shares from the mutual fund. And when you redeem your shares, when you sell your shares, you actually redeem the shares back to the mutual fund. There are no trades on an exchange when you're dealing with a mutual fund. And all trades with a mutual fund are done at the end of the trading day. So if I want to buy shares of a mutual fund on Monday, I put my order in during the day on Monday, and then I'll pay whatever the mutual fund is worth on the close of trading on Monday. And if I want to sell my shares of the mutual fund, I put my order in to sell. It's the same thing. My shares are redeemed at the end of the trading day on Monday for whatever the net asset value of the fund is on that day. Exchange-traded funds are set up the same way as mutual funds. They make diversified investments. You buy shares of the fund. And again, you're buying shares of the ETF, of the exchange-traded fund. And that gives you an indirect ownership of all the securities that the fund owns. And so now you have exposure to this diversity of stocks that you otherwise couldn't have. The difference between the exchange traded funds and the mutual funds is that the exchange traded funds are trading all the time on the market. They trade like any other stock on the stock exchange. You're buying and selling stock with another investor. You're not buying shares from the fund. You're not redeeming your shares to the fund. You're buying shares from another investor and you're selling shares to another investor. And the value of the fund changes every minute, like a stock. All the trades during one certain day are done different times and at different prices. Unlike a mutual fund, all the trades are done at the close of trading. And there's some slightly different tax rules that apply to exchange traded funds that apply to mutual funds, and we'll talk about those during the course as well. All right, and those are your basic investments in stocks. Another class of securities that hopefully that we're all familiar with are bonds. When you buy a bond, you're basically issuing debt. The purchaser of a bond is issuing debt to the entity that they're dealing with. So I can buy a bond of the a US government bond, or a bond of any government. I could buy a corporate bond. And if I buy a corporate bond, I'm buying a bond issued by a corporation. Or I could buy a municipal bond, which is a bond issued by a state or a city. And there are different tax rules that apply to each of those. And again, when we go over bonds, we'll talk about the different tax rules that apply to US bonds, corporate bonds, and municipal bonds. But basically, the investor in a bond is making a very different investment than an investor in a stock. With a bond, you're lending money to the issuer of the bond, and they're paying you a rate of interest. And that's the way you're going to make money. You're going to give them, let's say, $1,000 on day one. They're going to pay you back $1,000 after 5 years, and they're going to pay you a rate of interest during the term of that 5-year term. And it might be 1% interest, 2% interest. And the way you're going to make money is you're going to get interest income while you own the bond. And hopefully you're going to get the return of your money back when the bond matures. So when you make an investment in a bond, you don't really care if the company's sales increase, whether they increase dramatically, whether they fall somewhat. As what you're really interested in is the viability of the company. As long as the company remains viable and they can pay you back your money at the end of the term of the bond, you really don't care how well or how poorly the corporation has done, which is very different than the person who makes an investment in stocks. So bonds typically are less risky than stocks, but the rates of return are lower than the rates of return that you would hope to earn from a stock. A structured note is a different kind of bond. And it's a strange bond because typically you lend someone $5,000, let's say. They agree to pay you back 2% interest over each year for the next 5 years. And then after 5 years, they give you back your $5,000. With a structured note, you still are lending money to an entity. I'm still lending money to a corporation. I'm lending money to a municipality. And you want to get your money back at the end. But instead of earning a rate of interest, the amount they pay you is tied to the performance of an asset. It has really nothing to do with the time value of money. It has nothing to do with interest rates. And popular structured notes are people will lend money to a bank. Let's say they'll lend $50,000 to a bank, and they want to get their $50,000 back at the end of 5 years. But instead of earning a rate of interest, what they'll say is, assume that I had given you $50,000 and you invested $50,000 in the S&P 500. I want the upside of the S&P 500 over the next 5 years. And the bank will say, that's fine, except we're going to cap it. We're not going to give you the same upside because then you're getting all the benefit of the S&P 500. You're not taking the downside risk. So we'll give you the upside, and let's say over 5 years, we'll cap it to a 25% rate of return, so that you get the upside in the S&P 500, but it's limited, that if the S&P 500 goes up by more than 25%, you don't get the excess over 25%. But the benefit to the investor is that if the S&P 500 goes down, you're still going to get back your $50,000. You're still going to get back your initial investment. That's called the principal protected note. And that will be given a certain tax treatment. But what's really nice about that is you put in $50,000, you know, worst case scenario, you're going to get back $50,000. And if the S&P 500 goes up, you're going to get a rate of return based on that. And if it goes down, you don't care. There are sometimes notes are issued with partial and no protection. It's rare that a note has no protection, but other times a note will give you partial protection. So they say, look, instead of capping your upside at 25%, we'll give you the upside up to 50% over the next 5 years. But if you're going to get that additional upside, you're going to have to take on some of the downside risk. So if the S&P goes down by up to 10%, you suffer the downside that has occurred with respect to the S&P 500. So if you put in 50,000, after 5 years, that 50,000 would be worth 45,000. You're only getting back 45,000. You're not going to get back the full 50,000. However, if the S&P goes below 45,000, you're still going to get back 45,000. So 45,000 becomes your floor, but your upside goes all the way up to 50% instead of 25%. And you can decide whether you want a principal protected note, whether you want a partial protected note, how much of it has to be partially protected, and you weigh the pros and cons of both. And when a note has partial or no protection, you actually get different tax results than when it's principally protected. And again, those are things that we will talk about in a lot more detail during the class. Now, the next thing I want to talk about are options. And I have here equity options, options on stocks or options on indices. And I'm going to go over options in a lot more detail. And I'm going to focus on options on stocks, but the rules that apply, or the economics that apply to options on stocks, apply to options on anything. So once you understand the economics of an option on a stock or a stock index, the same economic rules are going to apply to options on commodities, options on currencies, options on anything. All right, so let's talk about equity options. So there are two types of options. There are calls and there are puts. When you buy a call, the buyer of the call has the option to buy the underlying stock at a specified price, but it has a specified time period. Options are wasting assets. Eventually, they all expire, and they just go away. Now, what the buyer of a call is hoping for is that the underlying stock will go up in value during the life of the call. So let's just go over an example. The investor buys an IBM July 50 call. So what does that mean in English? What that means is that the buyer has the option to buy 100 shares. Unless specified, all options are going to cover 100 shares. So the buyer has the option to buy 100 shares of IBM for $50 per share by the third Friday in July. And again, unless there's a specific date given, all the options that trade on the listed exchanges here expire on the third Friday. Now, there are weekly options, so you might see an option that says July 3rd, that will expire on July 3rd. If there's one that says July 8th, it'll expire on July 8th. If it just says July, it's going to expire on the third Friday in July. So obviously, if the person who bought this has the option to buy IBM for $50 a share, they're hoping that by the third Friday in July, IBM will be trading for over $50 a share. So if IBM were trading for $65 a share, they could exercise their option, buy IBM for $50, immediately sell it for $65, and they would have a $15 profit. And that $15 would be the fair market value of the call as well on the last day of its life. Now, whenever you want to buy a call, someone has to sell you that call. Options are derivatives, and the options don't exist in and of themselves. So when IBM issued stock, the company issued stock, people are buying the stock, buy the stock, and then people buy and sell the outstanding shares of IBM. Everyone in the market in IBM stock can make money. So if I initially buy IBM when it comes out, and I buy it for $35 a share, I then sell it to the next person for $38 a share. They then sell it to the next buyer for $45 a share. I've made $3, they've made $7. The person who buys it for $45 could then later sell it to someone for $60 a share. They can make $15 a share, and everyone can be making money. There's nobody losing money in those transactions. Now, the people who sold early and the stock continued to go up might have an opportunity cost in that they could have made more money had they not sold it, but nobody is losing money in those trades. With options, it's different. When I buy an option, I'm creating a right, I'm creating a contract, and someone has to sell it to me. And so someone is going to sell me that option, and they are going to be on the other side of that option. So the buyer of the option can decide whether they want to exercise it or not. If they don't want to exercise it, they can let it lapse, let it expire, and they'll just lose their original purchase price. And again, when I go over an example, I'll go into that in more detail. The writer of the option, the seller of the option, we call the writer of the option, is obligated to sell the underlying property at the price within a specified time period if the buyer of the option exercises their option. The seller of the option has no choice. They do not have an option. They must sell the underlying property. They receive a premium. So the buyer of the option makes a payment. The payment goes to the seller of the option, and the seller of the option keeps that premium. And what they're hoping is that the price of the stock stays where it is or it goes down, and they get to keep their premium. So again, let's go back to that same IBM July 50 call. The writer of that call has the obligation to sell 100 shares of IBM for $50 per share by the third Friday in July if the holder of the option exercises the option, right? Once the holder of the option exercises the option, that's it. The writer must sell the stock. So let's go over an example in more detail. So what I want to do is now go to the whiteboard. And again, I'm the buyer of call option. And let's keep using the IBM July 50 call. And let's say the price is $4. So again, what is the buyer buying? They're buying an option to purchase 100 shares of IBM at $50 per share by the third Friday in July. Now, that option, so if it's an American style option, it can be exercised at any time. Up to the third Friday. If it's a European style, it can only be exercised on expiration date. Right? And when we go through different planning ideas during the course, I'll point out when we would want to use an European style option as opposed to an American style option. But other than when the option can be exercised, American style options and European style options are exactly the same. And I realized that I'm started this in the middle of the page, and I probably should have started on the left side or the right side of the page. But for this example, we'll continue on with this. Okay, so the buyer of the option has the right to buy 100 shares of IBM at $50 per share. So let's assume now it's the third Friday in July. And let's assume that IBM is below $50. Well, you're not obligated to exercise your option. The owner of the option does not have to exercise. They can allow the option to expire. If they do that, the option goes away. They no longer have any rights to acquire the stock. And they've lost their premium. So in this case, they paid $4, right? But the $4, you multiply that by 100 because the option represents 100 shares. So their cost for the option was $400. They lose their $400. But what if IBM $40 per share? The option holder only lost $400. The stockholder who owns 100 shares lost $1,000. So it's nice. One of the pros of an option is your risk of loss is limited to purchase price. Of the option. All right, so this was the bad case. Now let's go over and let's do the good case. And what's the good case? The third Friday in July. IBM is above $50. So let's assume that IBM is $65. Now you have the option to buy 100 shares at $50 per share. You could exercise and immediately sell for $65 per share. Your option is worth $1,500. Cost of option is $400, and your profit is $1,100. Now you've made an $1,100 profit on a $400 investment. You know, that's a 275% rate of return. If someone bought 100 shares of IBM and it went from 50 to 65, their profit would be $1,500. So they would actually have made more money than you in terms of dollars, but their rate of return would have been $1,500 on a $5,000 investment, which isn't a bad rate of return, obviously, but on a $50,000 investment, making $1,500 is a 3% rate of return. So when you look at the upside, you go, gee, options give you this higher rate of return. When the stock goes way down, your loss is limited. It seems like buying options is a better investment than buying stock. Well, that's not always the case. Or obviously, or else everyone would just be buying options. So let's go to the next scenario. IBM is at $52 on third Friday. Well, you have the right to buy IBM at 50. So you're not going to allow the option to expire. You're going to exercise the option, then you're going to sell the stock at 52. So the value of the option is $2. So value is 200. Cost was 400. You lost $200. The person who bought the stock has a profit $200. All right, so this is an example where the price of the stock has actually gone up since you purchased the option, or the ending price of IBM is greater than your exercise price, yet you still lost money on your option transaction. Whereas the investor in stock has made money. They've got a profit of $200. All right, so you don't always do better with options. Also, options expire. Right? Stock ownership remains. So there's no time pressure when you own stock. So in the example where the price of the stock went down from 50 to 40, so yes, the option holder lost their $400. And I said the stockholder has an unrealized loss at that time of $1,000. But if in 2 weeks IBM recovers and goes back up to 50, the shareholder has gotten that benefit. They still own the IBM stock. They still have all the ups and downs of the IBM stock. The option holder, once their option expires, is out of it. So options are much more speculative. Than stocks. All right, and that's why the rate of return, when you look at it on a percentage basis, is so much higher for the option, but you're taking a lot more risk with respect to the option. All right, so that's the purchaser of the call option. And again, remember also that with call options, there's a buyer and a seller. So if the buyer makes money, the only way that they can make the money is if the seller loses money. And if the buyer loses money, then the seller makes money. But the big thing about derivatives, and this is true of all derivatives, and why it really is difficult to make money trading derivatives. So for those of you who want to start trading options, be careful. Derivatives are always a sum zero game. For every dollar that's made, that is earned, a dollar is being lost. All right, there are no free lunches in any securities market, but especially in the derivatives market. Anytime someone is making money in a derivative, there is another person losing the same amount of money. All right, so this is the buyer of the call option. Now what I want to do is look at what happened to the seller of the call option. So I'm going to erase everything. And again, you can go back and replay the tape if you want to, go over this example in more detail. And hopefully you've been writing things down. Okay, so now let's talk about the seller of the call option. And again, it's the IBM July 50 call. The seller is obligated. It's not an option with respect to the seller. The seller is obligated. So 100 shares, IBM at $50 per share by the third Friday in July. So again, we're at the third Friday in July. And good news for the seller. IBM is below $50. The option will not be exercised. And the writer will keep the $400. Now, what's interesting is it doesn't matter how much below $50 IBM is. If IBM is 49, they're going to keep their entire $400. The option's not going to be exercised. And if IBM goes down to 35, Either way, they will keep $400. So they just don't want IBM to close at the strike price or above. They want it to stay below the strike price. What happens when it doesn't go in their favor as well? And I'm going to give an extreme example here because I want to show you the amount of risk that the seller of a call option is taking. So it's the third Friday in July. I don't know, IBM merges with Apple or does something crazy happens with respect to IBM. And in the third Friday in July, IBM is trading at $500 per share. Well, if the owner of the call exercises the call, I've got to sell them IBM stock at $50 a share. I'm going to have to buy IBM stock in the marketplace at $500 a share. I'm going to lose $450 per share. And if I did one option, which is 100 shares, I've lost, I've got a value of negative $45,000. My proceeds were $400, and my loss is $44,600. So as you can see, when someone writes a call, and if they're not hedged, their upside is limited to the $400 that they took in, but their downside is really unlimited because the price of IBM could just keep going higher and higher and higher and higher. So when you have a position that's not hedged, we would call that a naked call. Right? And you have a lot of risk. If it was hedged, if let's say the person owned 100 shares of IBM, and they wrote a call, and many people do this because when they take in the proceeds from the call, it gives them an added rate of return. But now they're protected. So if IBM goes up to 500, they don't have to buy shares. They just deliver the shares they own. Now they're still not happy because they haven't gotten any of that upside. They're only getting $50 a share for their IBM when they deliver it. They're not getting the $500. So it still wasn't a good transaction, but they're not getting killed. They're not, their losses not just going up and up and up as the value of IBM keeps going up and up because they have the shares to deliver. This is called a covered call. And we will talk about covered calls in more detail later on during the course. All right, so remember, when you have derivatives and we have call options, if the buyer of the call option makes money, the seller of the call option is going to lose that amount of money. If the seller of the call makes money, the buyer of the call is going to lose money. So those are call options. The other type of option that we're going to deal with are puts. So what is a put option? Owner of put option has the right to sell 100 shares of stock at a specified price within a specified. So let's stick with IBM. So we have an IBM $50 July put at $4 also. So what does this mean? I buy the put, the owner has the right to sell 100 shares. IBM at $50 per share. And by the way, I haven't mentioned it, but the $50, the dollar value is called the strike price. That's the strike price of the option. That's the price at which the underlying shares are being bought and sold. All right, so the owner of the put is going to make money if IBM decreases in price. So, there's a saying on Wall Street that bulls make money, bears make money, pigs get slaughtered. And when you think stocks are going up, it's said to be bullish. If you think stocks are going down, that's said to be bearish. So if you're bearish on IBM, you think IBM is going to go down in price, you might want to buy a put option. All right, so now we come to the third Friday in July. And IBM is at $40 per share. Well, you have the right to sell 100 shares at $50 a share. You could go into the marketplace and buy it for $40 a share. So you're going to make $10 per share. Your option gives you the right to do that with respect to 100 shares. So the value of your option is $1,000. The cost of put is $400, and your profit is $600. And by the way, the values of the options are true and can be figured out this way only on expiration date. While there's still time remaining in the option will trade at a premium. People will pay to have that additional time. All right, if IBM was at $48 a share, the value of the put is $200. Cost of put $400. You have a loss of $200. Again, you would not let the put expire worthless. The put has value. You always take that value. And what it does is it decreases your loss. You would not let it expire. And if IBM is above 50, so if IBM is at $52, the value of your put is $0. Right? It's not worth anything to be able to sell IBM at $50 a share when you could just go into the marketplace and sell it at $52 a share. No one's going to pay you for that right. The value of your put is $0. Cost $400. Your loss is $400. And once again, When you're the purchaser of an option, your loss is limited to the amount that you paid for the put. IBM could have gone up to 500. It doesn't matter that it went up so much and went so much against you, because you're just going to let the put expire. You're not going to exercise the put and sell the stock at $50 a share when it's trading at 500. You're just going to let it expire. You're going to lose your $400. And again, let's just finish this up with the writer of the put. And again, it's the same option. It's the third Friday in July. It's the July 50 put. So we're at the third Friday. IBM is at 40. The value of the put to the writer is a minus $1,000. They received $400. And what do you know? Their loss was $600, right? So the owner's profit, the buyer's profit is the writer's loss. And that's always going to be the same. So let's just jump to IBM at 52. Value put is 0. I'm sorry, I left this number out here. The value of the put and proceeds were 400. And that's how we got our loss of 600. Here we have a value put of 0, the proceeds are 400, and our profit is 400. And once again, you can see that there's symmetry between the buyer and the seller. Here, the profit and the loss were 400. Here, the loss and the profit was 600. So when we're dealing with derivatives, there's always a zero-sum game. So now we've gone over the buyer of a call, the seller of a call, the buyer of a put, the seller of a put. Now, the next thing I want to do will be the last thing that we do with options, is I want to combine the transactions and to start to show you why we start to have problems in the tax law. Because we have a nice set of rules, as we'll see when we go through it, relating to the taxation of stock. Then we have another set of rules relating to the taxation of options. And if you look at stock in and of itself, the tax rules make a lot of sense. When you look at the rules relating to options, the rules relating to options make a lot of sense. Because when you think about them, you think about them as two different economic transactions, that they're two different instruments. But let's see what happens when we start combining things. And this is where I think it gets interesting. It also gets more complicated. And then we have to come up with tax rules to deal with this. But what if I do this transaction? I buy the IBM July 50 and I simultaneously sell the IBM July 50 put. Believe it or not, this equals the purchase of IBM for $50 per share in July. That if I said I wanted to enter into a contract today, and that I wanted to buy 100 shares of IBM in July, and I wanted to set the price today at $50 per share, I could do that in a contract. Or what I could do is I could buy the IBM July 50 call, sell the IBM July 50 put, and I have the same exact economics. So basically, I have the same exact economics as owning 100 shares of IBM. Right? And let's assume IBM is trading at $50 on the date the transaction was entered into. So if IBM was trading at $50 a share on the date the transaction was entered into, and let's assume that I purchase 100 shares of IBM, and IBM goes up to $60 per share. Right? If I purchased the 100 shares of IBM and at 50, and now it goes up to 60, my profit is $1,000. Now, let's assume that I could buy the call and sell the put for no cost. I'll go into, after we're finished, why that's impossible. But for these purposes, let's just assume that that's possible. So I buy the call and sell the put for no cost. Well, my call will be worth $1,000. The put that I sold is going to be worthless. My net gain is $1,000. That's the same as if I had bought the stock. Now, let's assume that we do the same thing. So again, we're purchasing at 50, and it's 100 shares. And IBM goes down to 35. Well, now I have a loss of $15 a share. I've lost $1,500. If I buy the call and sell the put for no cost again, the call will be worth nothing. So it'll be worthless, right? I don't want a call that gives me the right to buy IBM at 50 when IBM is trading for 35. The put will have a negative value of minus $1,500. So what do I have? I have a loss of $1,500. It's the same exact result as buying the shares. The reason that I said that I can never do this for a cost of zero is if I bought the IBM stock, I would have had to pay 100 shares, $50 a share. I would have to have paid $5,000. What the market is going to demand, the pricing of the options is going to make it so that the combination of the options will be the interest cost of $5,000 for the length of the options, for the length of time until the options expire. Now, if the stock pays a dividend, the dividend is also will affect the option pricing. But if you have a stock that doesn't pay a dividend, then no matter what the stocks are, you can have two very different stocks. You can have a volatile stock or you can have a very conservative stock that doesn't move a lot. The difference between the option prices will always be the same. And it's always going to be the cost to carry the position. Now, if I have a volatile stock, and let's assume that the transaction goes out, for 2 years, the call might be 30 and the put might be 27 with a volatile stock. So that each option is more expensive, but the net is 3. And if I have a non-volatile stock, the call might be 10. The put will be 7. So it's non-volatile. But the net is still 3. And this is called put-call parity. All right, so for those of you who like algebra, long call plus short put equals long stock. And when I say long, that means you own it. So you own the call. When I say short, it means you sold the put. and that is equivalent to long stock. And the opposite of this, short call plus long put, equals short stock. All right, these two formulas that I've just given you are going to become vital as we go through the course. We're going to have one very long session on the last one that I've just given you, short call and long put. Then we're going to go into another class where we'll spend a little less time, but long call and short put. But what this shows you is that I can end up with the same exact economics and use different financial instruments. And if I'm going to end up with different tax results because I'm using options as opposed to using stock, or again, I'm using options instead of doing a short sale, and we will talk about selling securities short in this course, then there's tax planning. Also, if I own stock and I want to hedge it, and I enter into one of these transactions, I would short a call and buy a put, and I've just eliminated all the risk of loss and opportunity for gain on my long stock, but I don't have a taxable event, something's not right there. And Congress is aware of that transaction, and Congress has taken steps to remedy it. So as I said, as we go through the course, we're going to go into a lot of anti-abuse sections, and a lot of the anti-abuse sections are going to deal with options and other derivatives. And it's because we can create the same economics by using derivatives as we can in using the physical stock. And whenever we can have the same economics and different tax results, there's a lot of mischief that taxpayers and their planners can do. So this is options. And I know this is a lot. Now, in the homework assignment that goes with this class, these things will be, again, we'll have examples in the homework problems that you can work through. And again, work through these examples, replay this if you have to. Hopefully you've written all this down. But really try to understand this, because we're going to keep coming back to this throughout the course. The last transaction that I want to talk about are notional principal contracts. And you should get to know these. These are very common transactions in the marketplace. You should know what they are. We will spend time on them in the course, but we're going to spend less time on these than we will on options. Because again, options are just going to come up throughout the course, because there's just full of anti-abuse sections that have to deal with options. And again, while I gave examples with respect to options on stock, the same rules with respect to puts and calls apply to puts and calls on anything. And a long call, short put, doesn't matter what the underlying property is, will give you the same economics as owning the underlying property. Okay, so a notional principal contract. What's a notional principal contract? It's a contract between two parties. Each party will make payments to the other based on the movement of prices on a notional amount. Right? And that's why it's called the notional principal contract. And the most common type of these contracts, and they're referred to as swaps. So when you read in periodicals, you read on the internet, you read articles, you hear people on financial shows talking about swaps, that's what they're talking about. No one in the real world calls these notional principal contracts, but for tax purposes, we call them notional principal contracts, swaps. We're talking about the same thing. And the most common one are interest rate swaps. And I'm going to show you how the swap market originated, and now it's gotten a lot more sophisticated. The first swap, I think, was in around 1981. So now that's been 40 years ago, and a lot has happened in those 40 years. Right? But what happened back then was banks had excellent credit rating. And could borrow long-term at cheap rates. But their assets were short-term, so they borrowed at short-term rates. Then we had some corporates at poor credit ratings and borrowing long-term was expensive. Borrowing short-term was cheap, but they needed long-term borrowings because of their business. Okay, so let's assume Bank A could borrow 100 million for 5 years at 4%. And I realize these interest rates are higher than today's interest rates. But again, I just want to use bigger numbers. I don't want to use today's numbers. It's going to be harder to show the savings. The savings are still going to be there, and people are still doing these things. But again, just for example purposes, bear with me with these higher rates. So they could borrow 100 million for 3 months, which is what they really want to do, at 2%. Right? And now we have the corporate. They can borrow 100 million for 5 years at 7%. Right? They've got to pay more because lenders are going to demand a higher rate of interest because they're taking greater credit risk. But no one thinks they're going to go out of business in 3 months. So they can borrow 100 million for 3 months at 2.5%. They're still going to have to pay a little more than the bank, but they're still going to get a cheap rate. So what they do is the bank goes into the marketplace and borrows 100 million at 4%. And remember, that's not a borrowing they really want to go and do. And the corporate goes into the marketplace. They borrow 100 million for 3 months at 2.5%. So the corporation has the 100 million they want. The bank has the 100 million they want. It's just that they borrowed at the wrong rates and at the wrong term, for the wrong term. So what do? What they do is they then enter into a contract with each other. So we have the bank and we have the corporate. And they enter into a 5-year contract with each other. All right, let me label everything. So we've got the bank here. We've got the corporate here. And the bank is going to pay to the corporate a floating rate. And the floating rate will be commercial paper minus 1%. And commercial paper is the 3-month rate. So let's assume when we first started this transaction, the commercial paper rate was 2%. And the corporate is going to pay to the bank fixed rate. And it's going to pay a fixed rate of 5%. And the contract is based on $100 million. So what ends up happening? If commercial paper rate equals 2%, then the bank pays 1%, bank receives 5%, and the bank pays on their borrowing 4%. So when you net all of these together, the bank is even. Bank pays nothing. Now we go to the corporate. The corporate receives 1%. It pays 5% and it pays 2.5%. So when everything is all said and done, the corporate pays 6.5%. And so when you look at the two entities, the bank saves 2% because the bank would have had to have borrowed short term at 2%. The corporate saves 0.5%. All right, so they're both saving money. And that's how swaps first started. You had banks who had excellent long-term credit rating, couldn't use it because they couldn't borrow on a long-term basis because it didn't match their assets. You had corporations who had okay short-term borrowing rates, bad long-term rates, but they ended up having to borrow long-term because they would build large factories or whatever, and they would do large spending plans that carried out for a number of years. Since they were going to have to spend money for a number of years, they wanted to fix their costs, so they wanted to borrow at a fixed rate for a long period of time, except they ended up not being able to borrow at the best rate. So again, in order to complete this diagram, I would have the bank paying out the 4%, right, to the market. And I would have the corporate paying out 2.5% to the market. And everyone comes out ahead. Right? And if the bank and the corporation default on any payment to each other, the swap goes away. And the bank now has a borrowing that it really doesn't want, so it would have to find a new counterparty to enter into a new swap. But the $100 million never changes hands between the corporation and the bank. And that's why it's called, again, a notional principal contract. That the $100 million is a notional amount. There's no $100 million going back and forth between the corporation and the bank. The only thing that's going back and forth between the corporation and the bank are the annual interest payments based on $100 million. These transactions have gotten a lot more complicated. All corporate treasurers use swaps, and they use it to try to lessen their cost of borrowing. And this is one example where the corporation has borrowed at a floating rate, and through the use of a swap has actually turned it into a fixed rate borrowing. The bank has borrowed at a fixed rate, and through the use of a swap has turned it into a floating rate debt. All right, so these are the instruments that we're going to be covering and going into all the tax rules for the remainder of the course. And the two instruments that I really want you to focus on and to really understand the economics of are options, because we're just going to keep coming back to options throughout the course, and notional principal contracts. If you understand those, you then are going to understand forward contracts, futures contracts, and I haven't talked about those, so let me finish up by quickly going over forward contracts and futures contracts as well. So we've gone over calls, we've gone over puts, and finally, the last two things I do want to talk about are forward contracts and futures contracts. And a forward contract, again, is a bilateral contract. It's a contract between two parties. And what one party says is that I will sell you some property at a certain time for a specified price, and you're going to pay me the money at that time, and I'll deliver the property to you. So an example would be a forward contract on gold. Party A is going to sell to Party B 100 ounces of 24 karat gold to be delivered at a warehouse on July 24th, 2010 for $1,000 per ounce. So they know the date that it's going to be delivered, they know the cost, and they know the quality of the gold. And by the way, this is a fixed contract. This isn't an option. It doesn't matter what the price of gold is on July 24th. Party A is going to deliver 100 ounces. Party B is going to pay $1,000 an ounce. And the difference between a forward contract and a futures contract is a futures contract basically has all the same terms as a forward contract. We deal with a specified property. There's going to be a specified amount. There's going to be a specified price, and there's going to be a specified delivery date. But futures contracts are traded on an exchange. They're not individual contracts. The futures contract has specified terms. So if it's a gold contract, it's always 100 ounces. It's always 24 carats. And there's a list of warehouses where the gold will be delivered to. And you can pick and choose whichever warehouse you want. And these contracts can trade on an exchange. So it's the same thing as a forward contract. It's just that you don't know who the other side of your contract is. It's constantly changing. But you know that if you're the buyer, you're going to be entitled to get delivery of the specified commodity at the end of the contract. And futures contracts can be on commodities, they could be on currencies, they could be on bonds. And like I said, they're publicly traded. All right, and then asset-backed securities, we're not going to cover asset-backed securities in this course. But there's something that out there, if anyone has questions on asset-backed securities, please let me know. All right, so that's the end of today's session. And as I said, I didn't talk about taxation at all, but I really want you to get a really good understanding of the economics of the securities we're going to be talking about. And I really want you to focus on option contracts and to a lesser extent on notional principal contracts. Okay, thank you.